Welcome back to Investing Talk Podcast.
Today we're looking at WULF, a company making a dramatic, high-stakes pivot in the digital infrastructure space.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The core story here is a really seismic shift in strategy.
Okay.
The company is rapidly transitioning away from its legacy foundation, which is traditional digital asset mining, and pivoting aggressively toward high-performance computing, or HPC, and core AI infrastructure.
That sounds like exactly the right move in the current market. I mean, you're trying to capture that massive AI demand wave, but everyone is trying to build an AI data center right now.
Right.
So what gives this company a structural competitive advantage? Why are they positioned any better than the others?
The advantage lies in their existing physical assets, and this is crucial, their power procurement.
Yeah.
They're leveraging their current footprint, which is largely powered by cheap, renewable energy.
Right, like hydro and nuclear sources.
Exactly, to become a dedicated, sustainably powered AI data center provider. In the world of AI, power is the ultimate constraint. So by having these low-cost, steady, renewable power agreements already locked in, they get two major edges.
And those two edges are what exactly?
First, cost efficiency. Their power costs are just significantly lower and more stable than anyone relying on, say, volatile fossil fuel grids.
Mm-hmm.
And second, the ESG appeal. Major tech and cloud players who are their target customers are desperately looking for carbon-neutral partners to meet their own sustainability goals.
So this pivot, it de-risks the business from just the wild swings of crypto prices.
It does. It ties them directly to the stable, secular growth of global AI deployment.
And that institutional validation is key. We've seen some evidence of this working already, specifically with their strategic partnerships.
We have.
The alliance with Google, which includes that warrant agreement to support future HPC expansion, that really highlights this shift in focus as a huge stamp of approval.
It is, and the big headline that really defines this whole strategic shift is the massive long-term contract they announced late last year.
Right.
They formed a joint venture with FluidStack, which is backed by Google, and that partnership is expected to generate a staggering $9.5 billion in contracted revenue over 25 years.
That figure $9.5 billion over 25 years is almost unbelievable for a company of this current size.
Yeah.
I mean, when you mention that kind of long-term cash flow visibility, that's the holy grail for infrastructure investors.
It is.
But let me push back a little on that. What's the risk with a contract of that size? Is it guaranteed cash or just potential revenue?
That's the critical nuance. It is contracted revenue, which means the pricing and the capacity commitment are largely locked in. That minimizes the market risk. But you're right to ask about the guarantee. The risk is minimized because the counterparty, FluidStack, has Google's backing. And if we connect this to the bigger picture, this contract isn't just about revenue. It provides the collateral needed to justify the immense capital expenditure required to build out the data centers.
I see.
It's what allowed them to go out and raise the billions they needed for the expansion.
So the contract funds the build-out. The build-out generates the revenue to pay the debt. It's a virtuous cycle, but only if they execute it perfectly.
Precisely.
Let's look at the numbers then, because the growth figures suggest the pivot is well underway. They reported Q3 2025 revenue of what? Approximately $50.6 million.
That's right, an 87% surge year over year.
Which is exceptional.
And that jump isn't just, a vanity metric. Crucially, the high-margin HPC lease revenue stream, the actual AI revenue, the future of the company, has started.
It's online now.
It brought in $7.2 million in Q3 alone. That $7.2 million is the proof of concept. It confirms the transition isn't just aspirational, it's yielding immediate, high-quality, recurring results.
And the operational efficiency looks good too, even with this massive expansion going on.
Yeah.
Gross margins hit a really robust 50.2% in Q3.
Yeah, that tells you they are managing their core variable cost power extremely well. That renewable advantage is showing up directly on the margin line.
So, looking forward.
Well, if we look forward, analysts are projecting this acceleration will do more than just continue. It's expected to dramatically amplify as the new capacity comes online.
What are the forecasts saying? The
average revenue forecast for 2026 is hitting $431.2 million. That's a massive 118.4% projected year-over-year growth.
Wow.
If they hit those numbers, this is truly a high-growth infrastructure play that is sprinting past a lot of established peers.
Okay, so it sounds like a fantastic story. Massive contracted revenue, institutional backing, exponential growth. But this brings us to the obvious tightrope walk here. How are they funding this colossal expansion? This is where the story shifts, I think, to the high-risk, high-reward proposition.
Precisely. They're aiming for scale at breakneck speed, and scale requires capital. What's fascinating here is just the sheer magnitude of the capital formation they've orchestrated recently, over $5 billion secured.
$5 billion?
And the balance sheet really tells the story of significant leverage being deployed to build capacity now, betting that the AI demand will pay it off later.
So what exactly did they raise, and what's the risk that comes with those specific instruments?
The primary sources include a substantial $3.2 billion offering of senior secured notes.
Secured, okay.
The secured aspect is important. It means if things go south, the bondholders are first in line to claim assets. This gives them lower risk, but it places a heavy fixed obligation on the company. They also secured another significant chunk via convertible senior notes.
The convertible notes, that's where investors really need to pay close attention. While senior notes just burden the debt column, convertible notes can burden the equity column.
Exactly right. Convertible notes carry an implicit risk of dilution. If the stock performs well and hits a certain price, the company will issue new shares to satisfy that conversion, increasing the total share count and diluting existing stockholders.
So the market sees that as a future overhang.
It does, even though it reduces the debt burden in the long run.
So they're clearly prioritizing building capacity over short-term earnings, taking on this colossal debt load to capture market share now. What's the immediate consequence of that strategy on the company's financial health?
It leads to substantial current losses. The company currently reports very negative net profit margins, reflecting the extreme cash burn that's typical during the build-out phase for any infrastructure company.
How negative are we talking?
To give you a sense of the scale of the aggressive spending, we are talking about net profit margins in the range of negative 336%.
Negative 336%. That's shocking.
Like
This underscores how capital-intensive this growth path is.
It does.
So how do we assess the sustainability of those losses?
We have to look at the debt-to-equity ratio, which is the ultimate measure of this high-wire act. It stands at a staggering 428.6%.
428%.
That is material leverage. It means the company has to execute flawlessly. Any operational underperformance, any significant delay, or any unexpected jump in CapEx would immediately stress their ability to service that debt.
So the path to profitability is unproven, and the margin for error is razor thin.
Very thin.
That makes the technical data we look at so much more relevant. The stock currently has a high beta of 4.31. For listeners who might not track this daily, what does a beta of 4.31 actually mean in practice?
It means it's a roller coaster. The stock is theoretically expected to move 4 times more aggressively than the overall market. If the S&P 500 moves up 1%, this stock might move up 4.31%.
But critically, the other way, too.
But critically, if the market falls 1%, the stock is likely to drop over 4%. This level of volatility is a direct reflection of that massive risk-reward profile we just discussed. It's suitable only for those with a genuinely high-risk tolerance.
And despite that risk, the technical picture shows the momentum has been building, which suggests institutional money is flowing in.
For sure.
We're seeing a consistent pattern of higher lows and higher highs over the past few months.
And confirmation of that uptrend is absolutely key here. The stock consistently trades above both its 50-day and 200-day moving averages. This technical setup indicates strong accumulation and confirms that the market narrative, the AI pivot, is overriding the short-term financial volatility for the big players.
And that bullishness is mirrored in the analyst community. Analyst sentiment is overwhelmingly positive, with a strong buy consensus in place.
It is. The average 12-month price target is at $16.71.
Which is more than 50% upside from recent levels. And some of those top-tier analysts have targets as high as $24.
If you look at the gap between the current price and those lofty targets, it suggests analysts fundamentally believe in the execution of that $9.5 billion contract. They're discounting the high debt because they expect the cash flow from the new AI centers to rapidly deleverage the balance sheet.
This raises a critical question, then. What are the near-term events, the catalyst, that investors have to watch to make sure the company is on track to hit those forecasts?
Okay, the next major financial event is the Q4 2025 earnings release. That's expected in mid-February 2026. The market will, of course, watch revenue growth, but the real focus will be on two things.
Which are?
First, margin improvement. Is that 50% gross margin sustainable, and is the cash burn rate slowing? Second, updates on the ramp-up schedule for the big data center projects, specifically the expansion phases coming online in Texas and Lake Mariner.
Those are the engines of future cash flow.
Exactly. There's also an interesting corporate restructuring event scheduled for early December that affects the equity structure, isn't there?
Yes. The mandatory conversion of all Series A preferred stock into common stock. This is a simplification event. It removes a layer of complexity, making the capital structure cleaner for institutional investors.
But, and this is a necessary deep dive, point mandatory conversion means an immediate increase in the outstanding share float.
So while it simplifies things and removes a potential overhang, short-term investors should probably prepare for a temporary increase in selling pressure as those preferred shares convert.
It's a trade-off. Structural benefit versus short-term float increase, but it does clear the decks for easier index inclusion or broader institutional ownership down the road.
Shifting to the speculative side, we often hear industry chatter about potential M&A. Given the company's unique position, is there any credible reason for a larger entity to be interested?
There is persistent market chatter about potential acquisition interest from a much larger technology or data infrastructure company.
Why them specifically?
The reason is specific. It's not just the physical data centers. It's the large-scale, dedicated, renewable-powered platform they possess. Acquiring this company means instantly securing massive, future-proof power capacity and highly desirable power purchase agreements that are nearly impossible to replicate quickly.
That makes perfect sense. In an environment where every major tech company is struggling to meet its power demands for AI, buying a company with established, cheap, renewable power rights is a shortcut.
It's a massive shortcut. And we also hear rumors about expansion beyond the U.S. speculation centers around new international plans, maybe in Europe or Asia, though those are unconfirmed.
Okay, so to sum up this complex story, the company represents a classic high-stakes investment. You have massive revenue momentum, the strategic partnerships, the green energy angle. It all screams multi-bagger potential.
That's right. But the critical risks are equally massive. The sky-high debt-to-equity ratio and the substantial current operational losses. The company is basically using tomorrow's contracted revenue to fund today's expansion.
So the key takeaway for anyone looking at this is that their ability to flawlessly execute that ramp-up converting that $9.5 billion stream into actual positive cash flow, that's the defining factor.
It is. If they falter on execution, the debt burden becomes suffocating. If they nail it, those aggressive analyst targets look completely achievable. It's a compelling, incredibly volatile story.
You have to decide if your capital is comfortable riding that 4.31 beta roller coaster to capture the AI infrastructure upside. A fascinating synthesis of risk and reward. The question for you, the listener, is whether the strategic advantage of renewable power and institutional support outweighs the acute leverage risk required to achieve this scale. Something to chew on before the next earnings call.
Absolutely.
That's all the time we have. If you found this discussion helpful, be sure to subscribe to the podcast so you don't miss our next breakdown.